I'm sure you heard a part of that. Can we just start with this 10-year Treasury range we've been stuck in for a number of months now, between 50 basis points and 95 at a high end in early June? Mike, do you think we've got the setup in front of us to break out of that?
Sure. First off, Jonathan, I don't think I can match last week's piano. My office is not large enough for a piano, but I could play a little kazoo.
I won't ask, Mike.
If that makes your week. In terms of the range on the bond market, I think that the depth of the bond market rally has been just, that story's been written way too many times. There's still yield, there's still balance in fixed income relative to equities and other risk assets. And as long as you have investors that are long risk assets and need some level of diversification, as long as rates are zero or negative almost everywhere in the world, the 10-year Treasury at 80 basis points offers, number one, balance for your portfolio and some hedge efficacy. And secondly, there is yield in the fixed income market. And 80 basis points may not sound like a lot, but if it rallies to 30, that's a significant total return. So I think that people are writing off the bond market too early. And I think that right now with the 10-year at 80 basis points, there is value there with the Fed on hold for the foreseeable future.
Yeah, Mike, that's right where I wanted to go, is within the internals of the market. We do that in the equity market all the time. What do you see on your desks of the appetite and the bid-ask? I mean, there's a wall of money out there. I get that. But what are the internals you see in that bid, that demand for fixed income paper?
So we don't see a lot of the fixed income universe way overweight duration or way overweight treasuries. What we look at is we look at a lot of the funds that are out there and to see where they stand relative to the benchmark. And you're seeing investors right now anywhere between flat and somewhat short duration. So that, from a technical standpoint, is a very positive technical for the bond market. I would say that the other very important point is kind of the volatility that we're seeing now in equity markets and that we're likely to see going into year end. It's likely to have a positive impact on the Treasury market as investors look for flight to quality. And in the near term, it may even have a positive tailwind towards the dollar as well as the flight to quality currency.
Here's what I'm struggling with, Mike. You say that there's probably going to be buying of treasuries, and yet I was reading your notes, and you're bullish on high yield. You're bullish on the riskiest credit. Isn't there a contradiction here that if people are looking for the safety of treasuries at sub 1% yields, why would they be confident that they're going to get any of their money back with a high-yield bond?
Well, I think, first off, there is a lot of merit to owning growth-related assets and things like high yield that have not benefited as much from the Fed coming in and buying everything in the investment-grade universe, buying treasuries and buying mortgages. They've kind of been left out there, and there's still a decent amount of yield in the high-yield market. The benefit of treasuries paired with credit is very significant. When you go long duration paired with credit, you actually create better balance in a portfolio. So in the event that there is a risk off, actually treasuries would rally. And in the event that there's a improvement in growth and treasuries may back up, you would see credit spreads tighten very significantly. So number one, I don't think that that's an inconsistency. Secondly, I think that when you invest in things like high yield and other fixed income related assets that are not treasuries or agency mortgages that are very liquid, you think longer term. And longer term, we do believe that you're going to have improvements in care for COVID. We're going to get back to better growth next year. And so as a result, you want to stay long growth related assets. But as we look at what's setting up right now in terms of the potential for election volatility, the potential for funding issues at the end of the year as banks are not in a great capital position to be able to provide a lot of liquidity to markets, we actually want to be in a position where we have a little duration going into that, but you're also in a position where you have dry powder to take advantage of dislocation coming at the end of the year.
Oh, well, hold on a second. Let's unpack some of that. You said dislocation into the end of the year. In other words, you're expecting some of the riskier credit to potentially sell off and potentially significantly heading into year end, and then you're going to be buying. What's your entry point?
So I'm really trying to divide the fixed income universe into two. One is the credit-related assets where you're relying upon growth improving next year, earnings improving on the margin, and just getting paid back. And in trading credit, it's very hard to jump in and jump out pre-election, post-election, going into year-end. So long-term, we still very much like owning credit. In the very near term, though, we look at factors like volatility. And so we look at VIX, we look at bid-offer spreads, as Tom was talking about earlier, and we get a little concerned that there's going to be volatility going to the election, and there's likely to be volatility going to year-end from a funding standpoint. So what we've done is, instead of reducing positions in credit-related assets, which are going to be dependent upon growth and longer term, we're trying to free up balance sheet and portfolios to be in a position to take advantage of dislocation. And that may be even things as basic as cash futures basis in the Treasury market, something that blew up during the COVID crisis, blew up in previous funding crisis, where you can earn very, very attractive returns by deploying your balance sheet.
On radio and television this morning, our simulcast, Michael Swell with us with Goldman Sachs out of Brandeis and LSE a few years back. Mike Swell, right now, what Lisa and I know with John Farrow is interview after interview, everybody says they're buying China debt. All my radar's up just because everybody seems to be in the trade. What's the risk, or what's the thought you have on what could be out there in 2021-22 for the certitude of owning China debt?
Well, I think you have two factors that are a risk to owning Chinese debt. One is the risk that growth and that the Chinese economy is very insular and continues to recover at a pace very different than the rest of the global economy. In the event that that does occur, that could create a situation where the Chinese central bank provides less accommodation, and you actually see rates rise and inflation pick up in China. That's a real risk. The other risk is that from a credit standpoint, people get concerned again about China, kind of the other side. And while the central bank has the ability to lower rates, you could have a situation where there's credit concern. I think that's less of a concern.